A single Reuters report. One name, Kevin Warsh. That's all it took to trigger a multi-billion-dollar sell-off across global markets. Gold, which had just hit an all-time record of $5,194.82 on Thursday, plunged over 5% in hours, falling to as low as $5,100 before recovering slightly to $5,232. That's a 400-plus swing triggered by speculation about who might run the Federal Reserve. Silver crashed even harder, dropping 3.6% to $111.99 after touching a record $121.64 just a day earlier. Platinum fell 3.7%. Palladium slipped 4%. Asian stocks dropped 1.3%. Treasury yields spiked. The dollar rallied, all because of a rumor, not a confirmed appointment, not a policy announcement, just speculation that Kevin Warsh might become the next Fed chair when Jerome Powell's term ends in May. This is what markets look like in 2026, hypersensitive to every whisper, driven more by positioning than fundamentals, capable of violent swings on incomplete information. Today we're dissecting how a single Reuters report moved billions, exposing why gold's historic rally made it vulnerable to this crash, revealing what Warsh's potential appointment actually means, and explaining why the next 24 hours could determine whether precious metals recover or collapse further. The once-in-a-generation rally. Before we dive into the crash, we need to understand just how extraordinary gold's January rally was. Gold is up over 20% in January. Not for the year, for the month. That's the largest monthly gain since January 1980, when gold was in the final stages of its legendary 1970s bull run, driven by double-digit inflation and geopolitical chaos. We're talking about a gain that happens once in a generation, maybe twice in a lifetime if you're lucky. Silver's performance was even more spectacular, posting gains that positioned it for potentially the strongest month on record. This wasn't normal market behavior. This was parabolic, vertical, unsustainable, and that's exactly why Friday's crash was so violent. When assets rise this fast, they become fragile, overextended, vulnerable to any catalyst that shifts sentiment. The bigger the rally, the harder the fall. And January's rally was massive. The Warsh trigger. So what exactly happened Friday morning in Asian trading? Reuters published a report naming Kevin Warsh as the probable pick for Federal Reserve chair. Not confirmed, not announced officially, just probable, according to their sources. The market reaction was immediate and brutal. Gold dropped 3% initially, with intraday plunges exceeding 5% at the worst point. Silver fell 3.6%, having already crashed from $121.64 to $111.99. Asian stocks. MSCI's Asia-Pacific Index, ex-Japan, fell up to 1.3%. U.S. futures edged lower across the board. Treasury yields climbed as bond prices fell. The dollar rallied sharply. Everything moved at once. Risk assets down, safe havens down, dollar up, yields up. This tells you the market interpreted Warsh's potential appointment as hawkish, meaning less likely to cut interest rates and more likely to maintain tight monetary policy. But here's the crucial question. Is that interpretation correct? And does it even matter if it's just a rumor? Who is Kevin Warsh? Let's talk about who Kevin Warsh actually is and why his name triggered this reaction. Warsh served as a Federal Reserve governor from 2006 to 2011, a period spanning the global financial crisis. He's 54 years old, has deep Wall Street connections having worked in investment banking, and is known for several key positions. Hawkish on inflation. Warsh has consistently argued that the Fed should prioritize price stability over employment or growth. He was critical of the Fed's aggressive monetary easing during and after the 2008 crisis. Skeptical of QE. He's questioned the effectiveness of quantitative easing, money printing, and warned about its long-term consequences for asset bubbles and wealth inequality. Believes in central bank independence. Warsh is a strong advocate for the Fed remaining independent from political pressure, which could create tension with Trump. But here's the nuance. According to Damian Bowie, portfolio strategist at Wilson Asset Management, Warsh prefers lower rates, but also wants a smaller balance sheet. This is crucial. Warsh isn't necessarily against rate cuts, but he wants the Fed to shrink its massive $7+ trillion balance sheet accumulated through years of quantitative easing. What does a smaller balance sheet mean? Tighter liquidity, less money sloshing around the financial system. Effectively, tighter monetary conditions, even if rates themselves are cut. For markets addicted to liquidity, this is hawkish, regardless of the rate level. Why markets fear hawkish Fed policy? Let's break down why the mere possibility of Warsh becoming Fed chair triggered such violent market reactions. For gold and silver, higher interest rates or tighter liquidity make precious metals less attractive. Gold and silver don't pay interest. When you can get 5% on treasury bonds, holding zero-yield gold looks less appealing. Additionally, hawkish Fed policy typically strengthens the dollar. Since commodities are priced in dollars, a stronger dollar makes them more expensive for international buyers, reducing demand. For stocks, tighter monetary policy means higher borrowing costs for companies, lower valuations for growth stocks, and reduced liquidity for financial markets overall. Tech stocks particularly sensitive to interest rates get hit hardest, which explains why U.S. equity futures fell. For bonds, if the Fed is less likely to cut rates or if it's shrinking its balance sheet, bond prices fall and yields rise. That's exactly what happened Friday. Treasury yields climbed. For the dollar, higher rates and tighter policy make dollar-denominated assets more attractive, strengthening the currency. A stronger dollar then loops back to pressure commodities and international stocks. The entire financial ecosystem is interconnected. Change expectations about Fed policy, and everything moves simultaneously. The overbought problem. But Fed chair speculation alone doesn't explain the violence of Friday's moves. To understand why gold fell 5% intraday, you need to understand market positioning. Shane Oliver, strategist at AMP in Australia, nailed it. Gold has been overbought and got ahead of itself. When an asset rises 20% in a month, it becomes technically overbought. This means too many traders are long. Everyone who wanted to buy has already bought. There are no new buyers to push prices higher. Profits are massive. Traders sitting on huge gains start thinking about locking them in, creating selling pressure. Leverage is extended. Many positions are held on margin. When prices start falling, margin calls hit, forcing liquidations. Momentum strategies reverse. Algorithmic traders program to follow momentum switch from buying to selling when the trend breaks. Gold at $5,594 was the definition of overbought. It had risen too far, too fast. It was vulnerable to a pullback, as Oliver put it, after its exponential rise. All it needed was a catalyst. The Warsh rumor provided that catalyst. The leverage unwind. Here's what likely happened mechanically during Friday's crash. Stage 1. Reuters report hits. Traders interpret it as hawkish. Initial selling begins. Stage 2. As gold starts falling from $5,594, traders with leveraged long positions start losing money. Some decide to cut losses and sell. Stage 3. That selling drives prices lower from $5,500 to $5,400 to $5,300. More leveraged positions hit margin call territory. Stage 4. Brokers start automatically liquidating positions that can't meet margin requirements. This forced selling accelerates the decline. Stage 5. Algorithmic trading systems detect the breakdown and add to selling pressure. Momentum traders who were buying the rally start shorting the decline. Stage 6. Gold briefly touches $5,100, down over 8% from the peak. Panic sets in. Then, just as suddenly, buyers emerge. Stage 7. Bargain hunters, physical buyers, and traders covering short positions create a bounce. Gold recovers to $5,232 by the time the dust settles. This entire cycle played out in hours, not days, hours. That's the power of leverage. It amplifies moves in both directions, creating violent swings that have little to do with actual changes in supply, demand, or fundamentals. The dollar's revenge. Let's talk about the dollar, because its rally on Friday was both cause and effect of the precious metals crash. Tim Kelleher, head of institutional FX sales at Commonwealth Bank, noted that the Warsh headlines triggered some dollar buying. Why? Because traders immediately priced in higher for longer interest rates, making the dollar more attractive. But here's the feedback loop. Dollar rises. Commodities fall. They're priced in dollars. Gold and silver drop. Investors flee to dollars as safe haven. Dollar rises further. It's self-reinforcing in the short term. The dollar had been weak for weeks, which helped fuel the commodity rally. When it reversed Friday, it pulled the rug out from under gold, silver, and other dollar-denominated assets. This is why gold bugs fear hawkish Fed policy more than almost anything else. Strong dollar policy is kryptonite for precious metals. The dangerous phase. Ole Hansen, head of commodity strategy at Saxo Bank, issued a stark warning about the current state of the precious metals market. He described the surge as entering a dangerous phase, where rapid price swings make it tougher for buyers and sellers to find common ground. What does this mean in practice? When volatility spikes, market makers pull back. These are the institutions that provide liquidity, constantly quoting buy and sell prices to keep markets orderly. But when prices are swinging 5 to 8% in hours, market makers can't manage their risk. They widen bid-ask spreads or step away entirely. When liquidity disappears, small orders create massive price moves. A $10 million sell order that would normally move gold $5 might move it $50 when liquidity is thin. This creates the dangerous phase Hansen describes, a market that's functional during calm but becomes dysfunctional during stress, exactly when you need it to work. Friday showed what happens when markets enter this phase. Gold swings 400 plus in hours. Silver plunges and recovers violently. Traders get whipsawed. Fortunes are made and lost, not on skill, but on timing and luck. The Swiss-UK gold flow. Buried in the chaos, there's a fascinating data point that actually supports the bull case for gold. Reuters reported that Swiss gold exports to the UK reached their highest level since August 2019, according to customs data. Why does this matter? Switzerland is the world's gold refining hub. Raw gold comes to Switzerland, gets refined to the highest purity, then gets shipped to where demand is strongest. The UK, specifically London, is the largest over-the-counter gold trading center globally. This is where institutional transactions happen directly between parties, not on public exchanges. When Swiss gold flows to London increase, it signals strong institutional demand. Banks, hedge funds, sovereign wealth funds, they're buying physical gold and taking delivery. This is completely different from speculative futures trading. Physical flows represent real demand from buyers who want the actual metal. The fact that these flows hit a 5-year high right before Friday's crash suggests the underlying demand for gold is genuine and strong, even if speculative positioning got overextended. Charteri-e-Core, Hong Kong's gold ETF surge. Another bullish signal. The Hang Seng Gold ETF surged over 9% during its Hong Kong trading debut Thursday. This is significant for several reasons. Asian institutional demand. A 9% pop on debut day shows strong appetite from Asian institutional investors for gold exposure. Cultural affinity. Asian investors, particularly Chinese, have deep cultural connections to gold. They tend to be long-term holders, not short-term traders. Diversification from dollars. Asian institutions are actively diversifying away from dollar assets. Gold is a primary beneficiary. The timing is ironic. Hong Kong's gold ETF debuts with massive enthusiasm Thursday. Gold crashes Friday on Fed chair rumors. But from a long-term perspective, the debut success confirms that Asian demand, which has been a major driver of gold's rally, remains intact. What happens next? The Friday announcement. So where do we go from here? Everything hinges on Trump's actual announcement Friday. Scenario 1. Warsh is confirmed. If Trump officially nominates Warsh and emphasizes his hawkish credentials, Markets could interpret this negatively for gold. The dollar might strengthen further. Gold could test support at $5,000 or even $4,800. But here's the counterargument. Warsh as Fed chair might actually increase gold's appeal long-term. If he shrinks the balance sheet and maintains tight policy, that could trigger economic stress or market dislocations, driving safe haven demand back to gold. Short-term bearish, long-term potentially bullish. Scenario 2. Hassett gets the nod. If Trump surprises markets and picks Kevin Hassett, the National Economic Council director viewed as more dovish, gold could rally immediately. Hassett is seen as more likely to cut rates and maintain easier policy. That would weaken the dollar and support precious metals. Gold could quickly recover back toward $5,500, $5,600. Scenario 3. Someone else entirely. Trump loves surprising people. If he picks a completely different candidate, markets would have to recalibrate entirely. Uncertainty itself is often bullish for gold as a safe haven. Scenario 4. No announcement. Delayed. If Trump doesn't announce Friday as planned, markets might interpret this as dysfunction or chaos. Also potentially bullish for gold. The point is, we're trading rumors right now. When actual facts emerge, the reaction could go either direction. Chart 3. The bigger picture. Fundamentals haven't changed. Let's zoom out from the hourly price action and look at the bigger picture. The fundamental drivers that pushed gold up 20% in January haven't disappeared. Geopolitical uncertainty. Still present. U.S.-China tensions, Middle East instability, trade conflicts, none of this resolved. Fiscal concerns. U.S. debt is still $36 trillion and growing. Deficits are still structural. This hasn't changed because of Fed chair speculation. Central bank buying. Central banks worldwide are still accumulating gold reserves. This buying continues regardless of who chairs the Fed. Dollar long-term concerns. Despite Friday's rally, the long-term case for dollar weakness remains. Fiscal instability, debt levels, and global diversification away from dollars are multi-year trends. Inflation hedging. Inflation hasn't disappeared. It's moderated but remains above target in many economies. Friday's crash was triggered by a policy rumor and amplified by leverage. It wasn't driven by fundamental changes to gold's supply-demand picture. This is why sophisticated analysts like those at Citi can maintain bullish forecasts even after crashes. The long-term thesis remains intact even if short-term volatility is brutal. The March 18th Fed meeting. Trump's Friday announcement is the immediate catalyst, but the next major event is the Fed's policy meeting on March 18th. Futures markets currently favor steady rates. No cuts at the March meeting, but they're pricing in cuts later in 2026. Here's what matters for gold. If the Fed signals cuts are coming, gold rallies regardless of who chairs it. Rate cut expectations weaken the dollar and support precious metals. If the Fed turns more hawkish, gold faces continued pressure. Higher for longer rates and strong dollar policy are headwinds. If economic data weakens, gold rallies as safe haven. Recession fears override rate concerns. The March meeting will provide actual policy guidance, not just speculation about who might provide it. Lessons from Friday's chaos. What should investors and traders take away from Friday's violent moves? Rumor-driven markets are dangerous. A single Reuters report moved billions. Basing positions on rumors rather than confirmed facts is gambling, not investing. Overbought markets are fragile. Gold's 20% monthly gain created vulnerability. Parabolic rallies set up violent corrections. Leverage kills. Traders with 10x or 20x leverage got liquidated on a 5% move. You can be right about the long-term direction and still get wiped out. The dollar matters. For commodities priced in dollars, currency moves can override fundamentals. Watch the dollar, not just the metal. Physical demand versus paper prices. Swiss gold flows and Hong Kong ETF demand remained strong even as paper prices crashed. This disconnect creates opportunities. Volatility is the new normal. 5% intraday swings in gold are becoming routine, not exceptional. Position accordingly. The bottom line, gold crashed from $5,594 to below $5,100 in hours on speculation that Kevin Warsh might become Fed chair. Silver fell 3.6%. The dollar rallied. Treasury yields spiked. It was a rumor-driven sell-off amplified by overbought positioning, excessive leverage, and thin liquidity. The crash doesn't change gold's historic 20% plus January gain, still the strongest month since 1980. It doesn't change the fundamental drivers: geopolitical chaos, fiscal concerns, central bank buying, dollar weakness fears. But it reveals how fragile markets have become, how quickly billions can evaporate on incomplete information, how leverage amplifies volatility in both directions. Trump's Friday announcement will provide the next catalyst. Warsh is hawkish short-term but might drive safe haven demand long-term. Hassett would be immediately bullish. Someone else would create uncertainty. The March 18th Fed meeting will matter more than who chairs it. Policy drives prices more than personalities. For now, gold and silver are in a dangerous phase where rapid swings make trading treacherous and holding positions nerve-wracking. The once-in-a-generation rally isn't over, but the easy money has been made. What comes next will separate the survivors from the casualties. If this breakdown helped you understand Friday's chaos, hit that like button and tell me, do you think gold recovers to $5,600 or falls to $5,000 next? This has been your guide to trading in the age of rumors. Thanks for watching, and I'll see you in the next one.